Hey, welcome back. Here's something most crypto investors never realize. Every single transaction on the Bitcoin and Ethereum blockchains is completely public. Every wallet movement, every large transfer, every accumulation pattern, all of it is sitting there in plain sight, available to anyone who knows how to read it. While most retail investors are checking price charts and reading Twitter for sentiment, professional investors are watching the blockchain itself. They are tracking what large holders are actually doing with their money, not what people are saying they are doing. This is called on chain analysis, and it is one of the most powerful and most underused tools available to crypto investors today. The blockchain cannot lie to you. Price can be manipulated short term, news can be misleading, social media sentiment can be completely disconnected from reality. But when someone moves $1 billion worth of Bitcoin, that movement is permanently recorded and visible to everyone. Today, I'm going to teach you how to read this data, what metrics actually matter, where to find them for free, and how to use on chain analysis to make smarter investment decisions based on evidence instead of noise. Let us get into it. What is on chain analysis and why does it matter? On-chain analysis is the practice of examining blockchain data directly to understand what is actually happening with a cryptocurrency network, rather than relying solely on price action or social sentiment. Every transaction on a public blockchain like Bitcoin or Ethereum is recorded permanently and is visible to anyone. This creates an enormous, transparent dataset that did not exist in any previous financial market in history. Traditional stock markets do not give you this level of visibility into what individual large holders are actually doing. Here is why this matters so much for investors. Price tells you what happened. On-chain data tells you why it might be happening and what could happen next. When you only watch price, you are reacting to the past. When you watch on-chain data alongside price, you are seeing the underlying behavior of market participants in real time. You can see when large holders are accumulating quietly before price moves significantly. You can see when long-term holders are starting to sell, often before that selling pressure fully shows up in the price. On-chain analysis gives you three categories of insight that price alone cannot provide. First, holder behavior. Are coins moving into long-term storage, meaning holders intend to keep them? Or are coins moving toward exchanges, meaning holders may be preparing to sell? Second, network health. Is the underlying network actually being used? Growing transactions and active addresses indicate genuine adoption. Stagnant network activity despite price increases can signal that price is being driven by speculation rather than real usage. Third, market structure. Is the asset concentrated in a small number of wallets, creating risk? Or is ownership becoming more distributed and decentralized over time? This is the layer of analysis that separates investors making decisions based on evidence from investors making decisions based purely on price charts and social media noise. Exchange flows, the most practical metric. Let us start with the single most practical on-chain metric for beginners, exchange flows. Exchange flows track the movement of cryptocurrency onto and off of centralized exchanges like Binance, Coinbase, and Kraken. Here is why this matters so much. When someone moves their crypto onto an exchange, the most common reason is that they intend to sell it. Exchanges are where trading happens, so depositing coins there is usually a precursor to a sale. When someone moves their crypto off an exchange and into a private wallet, the most common reason is that they intend to hold it long term. Self-custody, meaning controlling your own private keys, is not convenient for active trading. People who move coins to private wallets are signaling an intention to hold rather than sell in the near term. Exchange inflows rising significantly often precede increased selling pressure and potential price declines. Large amounts of coins arriving on exchanges represent potential supply that could hit the market. Exchange outflows rising significantly often signal accumulation and reduced selling pressure. Coins leaving exchanges are being removed from the readily available trading supply. Here is how to use this practically. When you see large, sustained exchange outflows over several weeks during a period of low or declining prices, it suggests that despite the negative price action, holders are choosing to accumulate and store their coins rather than sell. This divergence between negative price action and positive accumulation behavior is one of the most valuable signals in on-chain analysis. Conversely, when you see large exchange inflows during a price rally, it can signal that holders are preparing to take profits, which may indicate the rally is approaching exhaustion. You can track exchange flow data for free on platforms like CryptoQuant and Glassnode, which provide charts showing net exchange flow trends for Bitcoin, Ethereum, and many other major assets. Long-term holder behavior. The second critical on-chain metric category is long-term holder behavior. Blockchain analytics platforms classify Bitcoin and other crypto holders into categories based on how long they have held their coins without moving them. The most common distinction is between short-term holders, typically those holding for less than 155 days, and long-term holders, those holding beyond that threshold. This distinction matters enormously because these two groups behave very differently and have historically provided powerful signals about market cycles. Long-term holder supply, meaning the total amount of the asset held by long-term holders, tends to grow steadily during accumulation phases and bear markets. Experienced patient investors are buying and holding through the negative sentiment, growing their position relative to the more reactive short-term holder base. Long-term holder supply tends to decline during late-stage bull markets. This is when long-term holders begin distributing, meaning selling their positions to the newer, more excited buyers entering the market near cycle tops. This distribution by experienced holders into retail enthusiasm has historically been one of the most reliable signals of approaching market tops. Here is the practical application. When long-term holder supply is rising consistently while price is flat or declining, it suggests smart money accumulation is happening beneath the surface, even though the price action looks unimpressive. This pattern has historically appeared during the best long-term entry opportunities. When long-term holder supply begins declining sharply during a strong price rally, it suggests that the patient holders who accumulated at lower prices are now distributing into the excitement, which can be an early warning sign that the rally's sustainability is weakening. This metric works best as a confirming signal alongside other indicators rather than as a standalone trading trigger, but it provides crucial context about which type of market participant is currently in control. Whale watching and wallet concentration. The third major category of on-chain analysis involves tracking large holders, commonly called whales, and understanding how concentrated ownership is across the network. Whale wallets, typically defined as addresses holding very large amounts of a cryptocurrency, have an outsized impact on price because their transactions are large enough to move markets significantly. Here is what to watch for with whale activity. Large wallet accumulation. When the number of wallets holding significant amounts of an asset is growing and the total amount held by these large wallets is increasing, it suggests sophisticated investors are building positions. This is often visible well before retail attention catches up to a developing opportunity. Large wallet distribution. When large wallets begin reducing their holdings, particularly when this coincides with price strength, it can signal that sophisticated holders are taking profits ahead of a potential reversal. Specific large transactions. Platforms like Whale Alert track individual large transactions in real time, showing significant movements of crypto between wallets and exchanges. While individual transactions should not be overinterpreted, patterns of repeated large transfers toward exchanges from previously dormant whale wallets can be meaningful signals worth investigating further. Wallet concentration is a related but distinct metric worth understanding. This measures what percentage of total token supply is held by the largest wallet addresses. High concentration, where a small number of wallets control a large percentage of total supply, represents a meaningful risk factor. Those concentrated holders have the power to significantly impact price if they decide to sell. This is a particular concern for smaller altcoin projects where founder and early investor wallets may control extremely large percentages of total supply. Declining concentration over time, where ownership gradually distributes across more wallets, is generally a healthy sign for a project's long-term decentralization and reduces the risk of any single holder dramatically impacting price. Tools like Glassnode, Nansen, and blockchain explorers specific to each network allow you to track whale wallet behavior and concentration metrics directly. Network activity and valuation metrics. The final category of essential on-chain analysis covers network activity and on-chain valuation metrics that help you assess whether an asset is being genuinely used and whether its current price reflects fair value relative to historical patterns. Active addresses measure how many unique wallet addresses are interacting with the network during a given period. Growing active addresses over time indicate genuine expanding adoption and usage. Stagnant or declining active addresses despite a rising price can signal that price appreciation is being driven by speculation rather than fundamental growth in usage. Transaction volume measures the total value being transferred across the network. Sustained growth in transaction volume, especially when it grows faster than price, suggests the network is becoming genuinely more useful and valuable, not just more expensive. The MVRV ratio, which stands for market value to realized value, compares an asset's current market capitalization to its realized capitalization, meaning the aggregate price at which all coins last moved on-chain. This ratio essentially tells you whether the average holder across the entire network is sitting at a profit or a loss relative to their cost basis. Historically, when the MBRV ratio reaches extremely high levels, it has indicated that the average holder is sitting on very large unrealized gains, which has historically coincided with periods of increased selling pressure as people take profits. When MVRV drops to historically low levels, it indicates the average holder is near or below their cost basis, which has historically coincided with capitulation phases and market bottoms. These metrics work best when viewed together rather than in isolation. Growing active addresses, rising transaction volume, and a moderate MVRV ratio together paint a picture of healthy, sustainable growth. The opposite combination, stagnant addresses, declining volume, and extreme MVRV readings, suggests caution is warranted, regardless of how the price chart looks. Let me bring your complete on-chain analysis framework together. Exchange flows tell you whether coins are moving toward exchanges, suggesting potential selling, or away from exchanges into private storage, suggesting accumulation and intent to hold. Long-term holder behavior tells you whether experienced patient investors are accumulating during quiet periods or distributing into retail excitement near cycle tops. Whale watching and wallet concentration tell you what large, sophisticated holders are actually doing with their capital and how much risk exists from concentrated ownership in any specific project. Network activity and valuation metrics, including active addresses, transaction volume, and the MVRV ratio, tell you whether genuine adoption is growing and whether current pricing reflects historically reasonable or extreme valuation levels. Here is the most important principle to remember. No single on-chain metric should ever be used in isolation to make a major investment decision. The real power of on-chain analysis comes from looking at multiple metrics together and finding where they confirm or contradict each other. When exchange outflows are rising, long-term holder supply is growing, network activity is expanding, and MVRV is at reasonable levels, that convergence of evidence tells a much stronger story than any single data point alone. Free platforms like Glassnode, CryptoQuant, and Santiment give you access to most of these metrics without significant cost. Spending just 15 minutes reviewing these indicators before making any significant investment decision will give you a perspective that the vast majority of retail investors never bother to develop. The blockchain is telling you a story every single day. Most people are not listening. Now you know how to read it. If this masterclass gave you a genuine framework for using on-chain data, please hit the like button and subscribe. This is the kind of analytical edge that separates informed investors from everyone simply watching price charts. Drop a comment below and tell me which on-chain platform you are going to start using first. I read every comment and I will point you toward the specific metrics most relevant to your situation. I will see you in the next one.